For evaluating mutual funds, different mutual funds, we are going to compare two mutual funds with this formula: Sharpe ratio, Trainer ratio, and Jensen ratio. Sharpe ratio will consider the standard deviation, that is total risk of the scheme. The risk-free return is treasury bill rate. Higher the standard deviation, higher is the risk, hence lower the Sharpe ratio. We are going to divide with the total risk, that is standard deviation, and the numerator will be actual return of the mutual fund, and minus you have to deduct the risk-free return of treasury bill, risk-free return of a treasury bill or government security. So Sharpe ratio is calculating the comparing the two schemes. You can compare the two small cap schemes, or you can compare the large cap with a small cap scheme. But if you compare large cap and small cap, it is worthless. The category of comparison, category of two schemes should be same. Both mutual funds should be of small cap, both should be of medium cap, or both should be of large cap. If you compare the large cap scheme with a small cap, it is not a proper comparison, it is worthless. And always you will find the return on the mutual fund is numerator. You are adjusting with the deducting the risk-free return from the return on mutual fund, and dividing with the total risk of mutual fund, that is standard deviation of the mutual fund. Scheme Y gives 10% return while scheme Z gives 8% return. The risk-free rate is 4% and standard deviation of Y and Z is 8% and 4% respectively. Then their Sharpe ratio are 0.75 and 1. It is easy. 10 minus 4, 6. 6 divided by 8. 6 divided by 8, 0.75. 8 minus 4, 4, numerator is 4. 4 divided by 4, you will get 1. Sharpe ratio for Z scheme is 1. Scheme Y is having superior performance based on returns, but scheme Z is better performer on the basis of risk. You can see the risk is less in Z. The total risk is the indicator of standard deviation. Standard deviation will show the total risk of mutual funds. 4% is less risk in Z and 8% is higher risk in Y. So if you compare on the basis of risk, Z is better performer, and if you compare with returns, the returns are greater in case of scheme Y. So when you are using this formula of Sharpe, you are deducting the risk-free return, okay, and how much extra return an investor will receive on holding a risky asset. If you are holding a risky asset, how much extra you will earn from the mutual fund compared to GSEC and compared to treasury bills, how much extra you are earning. If you are holding a risky mutual fund, how much extra you are earning compared to treasury bill. Treasury bill gives a guaranteed return, but mutual fund, they are very risky. They will give returns if market is going up, and if market is falling, that time this asset is very risky. So how much extra we are earning, this we will come to know from the Sharpe ratio. Usually any Sharpe ratio should be greater than 1. Greater than 1 is good for investors. Sharpe ratio higher than 2 is rated very good. Ratio of 3 is excellent. Ratio under 1, below 1 is suboptimal. That means it is underperforming. Less than 1 means the risk is high and Less than 1 indicates that it's a risky asset and the returns are not good from the mutual fund. So Sharpe ratio greater than 1 is good, greater than 2 very good, greater than 3 Sharpe ratio is excellent. What is the second ratio for evaluation of mutual funds? You can compare two small cap, two large cap schemes, two medium cap schemes, two equity funds, two debt funds. You cannot compare equity fund with a debt fund. You have to compare equity fund with equity fund only. And there are many companies, private and public, even offshore funds are there in equity funds. So you can compare an offshore fund with the Indian fund. Trainer ratio, it is developed by Jack Trainer. This ratio is similar to Sharpe. Numerator is same, return on security and minus risk-free return, but the denominator is different. That is beta of the mutual fund. Trainer uses the systematic risk, the risk which is called as market risk, which cannot be avoided. This is represented by beta. Sensitivity to market movements. When market is going up or down, beta will measure the securities sensitivity to market movements. Higher the trainer ratio, better it is. Example, scheme Y gives 10% per annum returns while scheme Z gives 8% per annum returns. If risk-free return is 4% and beta of the stock beta of the scheme Y and Z is 0.9 and 0.5 respectively, then their respective trainer ratios are: first take the actual return 10 of scheme Y. First we will calculate for scheme Y 10 minus risk-free return, that is 4. Numerator is 6. 6 divided by 0.9 beta. Answer is 6.66667. Okay. And next for scheme Z we will calculate the return is 8%, actual return minus risk-free return 4. 8 minus 4, numerator is 4, divided by beta 0.5, this is 8. Answer is 8. So trainer ratio you can compare. 8 is better. Higher the trainer ratio, better it is. 8 is better than 6.667. Scheme Y is having 10% return, but scheme Z is better performer on the basis of risk, on the basis of beta. So if you compare the trainer ratio, Z scheme is better on the basis of risk, and scheme Y is giving greater returns, 2% extra returns, but the risk is higher in case of Y. On the basis of risk, scheme Z is better, and on the basis of returns, scheme Y is better. Okay. Next is Jensen Alpha. This is a risk-adjusted return generated by mutual fund scheme relative to expected market return, predicted by a CAPM model, capital asset pricing model. This measure was developed by Michael Jensen. Alpha can be negative or positive. Expected return from the fund. This is CAPM formula. CAPM formula is expected return from the mutual fund is equals to risk-free return plus beta of fund into RM minus RF. RM is the risk return on market index. RM is a return on market index minus risk-free return. where RF is the risk-free return, RM is the average market return or benchmark return. This return can be of Nifty index. If Nifty index in 1 year is going up by 12%, so we will write average market return of Nifty, RM, that is return on market index. Jensen Alpha is calculated by subtracting the expected return from actual return of the fund. Jensen Alpha is equals to actual fund return is given in the question. A mutual fund A is having 10% return and expected CAPM return, which you have calculated above with this formula. You can deduct from that. 10% is the actual return of mutual fund and minus expected return of this mutual fund. Actual minus expected. Higher alpha means superior fund performance. If actual return is more and expected CAPM is less, that means you are very lucky that you are getting actual return more in mutual fund and your expectations were less. So this is a superior fund performer. Actual return is 12 and you are expecting only 10% with CAPM. So 2% Jensen Alpha, 2% extra you are getting. Positive alpha means this is a superior mutual fund which is giving you more than the expectation. So expected return, you have to use the formula of CAPM, and with a positive alpha means you are getting extra return more than the expectation. This is called as outperforming mutual fund. Outperforming mutual fund because if you compare with the market is going up by 10%, but your fund is going up by 12%. So this is positive alpha, 2% extra performance, outperformer. This mutual fund is outperformer. And second, if you are getting actual return less, your actual return is 8% and the expectation of CAPM return is 10%, you will get negative alpha. Negative alpha means it is underperformer. It is underperformer. The only problem with this measure is it ignores the unsystematic risk and it focuses only on systematic risk. In Jensen, we are not considering the total risk of market. We are only considering the risk which is unavoidable. It is only considering the beta of the fund. So when you are comparing two mutual funds, you have to use this formula. It will be given in the question which kind of tool you have to use, whether it is Jensen or it is Sharp or Trainer. It will be given in the question. For example, fund X and Y beta value is 1.1 and 0.8 respectively. Assume the market rate of return is 17% and risk-free return is 8%. What is beta? Beta calculates the market risk. Fund X is having beta of 1.1 and fund Y, mutual fund Y, is having beta of 0.8. So this is the risk of market. Changes in the market movement and sensitivity to market movements is 1.1. Sensitivity of mutual fund of Y is having 0.8 value. So this factor 1.1 and 0.8, you can see X is more sensitive, 1.1, and Y is less sensitive, 0.8. Okay, so sensitive to market movements is called as beta value. Assume the market rate of return. This is the Nifty returns. In 1 year, Nifty is going up by 17%. Nifty is NSE. Nifty is index of 50 stocks index of NSE. And this is going up by 17% in 1 year. The treasury bills are giving return of 8%. Treasury bill is very stable and it gives 8% constant return. We have to use CAPM formula. Expected rate of return, capital asset pricing model. First RF, risk-free rate plus beta into return on market index. Return on market means Nifty returns are 17%. And if we compare with the risky asset and the non-risky asset, market index is very risky and non-risky asset is 8. If you adjust the risk-adjusted returns means return on market Nifty. If you compare with the stable treasury bill returns, that is risk-free returns of 8%, 17 minus 8 into 1.1 plus 8. So first solve the first bracket, this bracket. 17 minus 8, 9. 9 into 1.1, 9.9 plus 8, 17.9. Second, for the second fund Y, risk-free return RF on treasury bill plus beta into return on market index 17, that is Nifty, went up by 17% in 1 year. In 1 year, treasury bill gave returns of 8%. 17 minus 8, 9 into 0.8, 9 into 0.8, 7.2 plus 8, 15.2. So you have to go backwards. From backward, you have to come in the front. So first, solving with the BODMAS rule with bracket, solve the bracket first, multiply and then add. Jensen Alpha of fund X, actual return of fund. This is given in the question. The mutual fund is giving return of 20%. This is given in the question. And your calculation, with your calculation, you should get 17.9. So actual return is more than the expected return. In this case, fund X is outperforming. It is giving more returns, 2.1%. We are expecting only 17.9, but we are getting more, 20% in this fund. 2.1 is extra, positive alpha, positive Jensen Alpha of fund X, superior performer. Compare with the second, first solve the second one, Jensen Alpha of fund Y, actual return given in the question 16%. Minus expected return of fund Y 15.2, 16 minus 15.2, that is 0.8. This is also giving superior performance. You are getting more returns and your expectation is 15.2 only. You are getting 0.8 extra. But naturally you can see that fund X is giving better returns compared to fund Y. You have big margin in fund X if you compare with fund Y. 2.1% extra. So fund X is beating the fund X is better than the fund Y. Fund X is better as it has beaten the expected rate by a big margin. So this is Jensen returns. Jensen Alpha. Both is having positive. Jensen Alpha positive in case of fund X, Jensen Alpha positive in case of fund Y. But higher the Jensen Alpha, better it is. So these tools are used for comparing two mutual funds. You can compare and you can select mutual fund for investment. You can use their past performance, historical returns, last 5 years, what was their average return, what was the beta, what was the standard deviation, what is the risk-free return in the last year. You can compare and you can select the proper mutual fund on this basis. And using the CAPM, you can calculate the Jensen Alpha. Okay. Now, what is NAV? NAV is a net asset value. Price of mutual fund is called as NAV. You have to calculate the NAV of XYZ mutual fund scheme. This is a mutual fund XYZ Limited. And in this scheme, there are some units outstanding. Units outstanding means these units are sold in the market. They are floating in the market of around 75,000 units. The investment value of mutual fund holdings. Mutual fund had invested in different stocks, in variety of stocks, and the value they have calculated as on today is 12,80,000. This is the multiplying with the current rates of those stocks, and you have got 12,80,000. So mutual fund has invested pool of money in different securities, and the value today is 12,80,000. So second is market value of investment in GSEC. So the GSEC value today is 11,19,000. With the current market price, if you multiply with the number of GSEC they have purchased, you get this data, 11,19,000. Other assets of this mutual fund scheme is having 1,10,000. The total liabilities. Now mutual fund is also having a liability. If they have not paid some expenses, some outstanding expenses are there. So this is a very big company. So they get a flexibility of paying liabilities, paying their expenses later on. So it's a big company. So they have outstanding expenses. They have given us information about liabilities, 70,000. What is the solution? Mutual fund will take into consideration all the assets and all the market value of stocks and GSEC. They will add up. Okay. So mutual fund is risky. That investment value is 12,80,000 plus 11,19,000 plus 1,10,000 minus total liabilities 70,000. If this investment value gets reduced, it is very risky. Okay. With a proper market research, you have to select the investments. If you take any wrong decision, the market value of investments if going down, then it will affect your NAV. So mutual fund, why it is risky? You have to study before investing. The AMC, Asset Management Company, they invest in the securities. Okay, so whether you are a risk taker or risk averse investor, it will affect you. It will affect your returns if you are not selecting the proper mutual fund. So you can calculate the NAV, market value of investments, other assets, and deducting the total liabilities from this and dividing with the number of units. You will get the price of a mutual fund, that is 32.52 per unit. This is the NAV of this mutual fund. Second question, calculate the NAV of BNB Limited with the following information. Number of units outstanding 95,000. Market value of investment in stocks 13,45,000. Investment is an asset. Second, market value of investment in GSEC, government securities 12,50,000. Other assets of the fund rupees 2,20,000. You will add all the second, third, and fourth 13,45,000 plus 12,50,000 plus 2,20,000 minus liabilities 1,30,000. Deduct 1,30,000 and you will get the net assets available with the company divided with the outstanding units of mutual fund. Answer is 28.26 per unit. So all the mutual funds, the NAV is calculated every day after market is closing. After 3:30, all the mutual funds have to calculate their NAV, taking into consideration the closing prices of those securities in which they are investing or they have invested. So all the detailed records they have to maintain in the books of accounts, and in the balance sheet they have to update the market value on daily basis. Market value of stocks will change. So you have to calculate the NAV in this way. Total assets minus liabilities upon number of outstanding units.